Despite a global trade war, India managed to grow its exports in 2018, but high crude prices and rising domestic demand continued to inflate the trade deficit at a faster rate. The year started with monthly trade deficit soaring to a 56-month high. By October, it had risen to more than $153 billion. Despite reports of crippling capital inadequacy in the wake of the new goods and services tax regime, double-digit export growth continued for half of the year. Also read, India's export growth plunges to 0.8% in November, trade deficit shrinks. Source, Ministry of Commerce. India's current account deficit (CAD) is expected to triple to $19-21 billion in Q2 of FY19, or about 3% of the GDP, from the modest $7 billion in Q2 last fiscal year, economists predict. As a result, the government placed import restrictions and raised inbound duties on 6 separate occasions for hundreds of products including textile inputs, steel, mobile phones and solar panels, among others. The move was strongly criticized for raising protectionist barriers at a time when economic growth was tepid. Also read, to cut trade deficit, India plans to boost export of 200 products to China, but India managed to navigate through a field of tariff landmines as a trade war between the United States and China heated up throughout the year. New Delhi countered threats by the Donald Trump administration to cut market access for Indian goods by entering protracted negotiations with the U.S. that continue at the time of writing.